Quick disclaimer before we go any further. This is education and analysis, not financial advice. Silver is volatile. Your situation is your own. Talk to a qualified professional before making any decisions. With that out of the way, let's get into it. If you own silver right now, you've been on a ride almost nobody saw coming. 4 months ago, silver hit $121 an ounce. It was the all-time high. People were calling for $200, $250, even $300. Then, in a single trading day in late January, the price crashed 31%, the biggest one-day fall since 1980. By April, silver was sitting near $74, and the people who bought at the top were watching paper losses pile up and wondering whether the whole story they bought into was even real anymore. Here's where it gets interesting. As I'm recording this, silver is back above $80. That's a $6 move in roughly 1 week. So something changed. And whatever changed is happening right alongside 3 other things that are about to land at the exact same time. May 15th. 8 days from now, Jerome Powell's term as Federal Reserve Chair officially ends. His replacement, Kevin Warsh, just cleared his Senate Banking Committee vote on April 29th along straight party lines. The full Senate vote is expected the week of May 11th. He's almost certainly going to be confirmed. 3 days before that, on May 12th, the next U.S. inflation report comes out. And the geopolitical event that's been crushing silver for months, the Strait of Hormuz crisis, appears to be quietly de-escalating. That's why the price is moving. To understand what May 15 means, you have to understand the story that got us to this exact moment. And it's a story that's been confusing a lot of investors, because there are really 3 different stories happening at the same time, all pulling in different directions. The first story is structural. Silver's been in a supply deficit for 6 straight years. The world consumes more silver than it mines, and has done since 2020. The Silver Institute estimates the cumulative shortfall now exceeds 800 million ounces. Above-ground stockpiles have been quietly drained to cover it. Mine supply can't respond quickly because roughly 70% of silver comes as a byproduct of copper, zinc, and lead mining. Producers can't just open new silver mines because silver got expensive. The average time from discovery to production is 7 to 10 years. That's the bullish foundation. It hasn't gone anywhere. It's still true today. The second story is industrial. Silver isn't just jewelry and coins anymore. Solar panels use silver in the electrical paste that makes them work. Every electric vehicle has silver in its electronics. AI data centers use silver in power distribution and thermal management. And the 4 largest tech companies on Earth, Microsoft, Google, Amazon, Meta, confirmed combined capital expenditure of around $725 billion in 2026. That's nearly double last year's spend. Silver represents less than 1% of the cost of building a data center, which means industrial buyers are essentially price insensitive. They buy what they need, regardless of what the spot price is doing. That's the second bullish leg, also still intact. The third story is the one that crashed the price, and this one is purely financial. In the months leading up to January 2026, the market was betting that the Federal Reserve was about to cut interest rates aggressively, inflation was coming down, the economy was slowing. Silver, like gold, doesn't pay interest. So when bonds yield 4% safely, bonds compete with silver. When rates fall, the competition disappears and money flows back to precious metals. That's the playbook silver was running on. Silver ran from $30 to $120 in roughly 12 months on that expectation. Then on January 30th, the White House announced that Kevin Warsh would be nominated to replace Jerome Powell as Federal Reserve Chair. The market knew Warsh's reputation. He'd been on the Fed board from 2006 to 2011. He was famously hawkish, meaning he prioritized fighting inflation over stimulating growth. In June 2008, with the financial crisis already starting to crack open, Warsh told his FOMC colleagues that inflation risk, in his view, was still the bigger danger to the economy. That's a statement that ages a particular way. So when his nomination dropped, the market repriced everything in hours. If Warsh meant higher rates for longer, silver lost its tailwind. The price fell 31% in a single day. And almost immediately after that, the Strait of Hormuz situation flared up. Oil spiked toward $100, inflation reaccelerated to 3.3%, and any hope of near-term rate cuts evaporated entirely. That's how we got from $121 to $74. None of it was about silver's fundamentals. All of it was about the financial weather around silver. Now here's what nobody talks about. The story everyone heard about Warsh, the hawkish 2008 guy. That's actually not the version of Warsh who showed up at his Senate confirmation hearing on April 24th. That part's worth slowing down for. I've spent more time than I'd like to admit trying to figure out who Kevin Warsh actually is in May 2026, and the honest answer is nobody really knows. Not the markets, not the analysts, probably not even Warsh. He's 56 years old. He served on the Fed board from 2006 to 2011, so he was inside the building for the entire 2008 financial crisis. He left to become a fellow at the Hoover Institution and spent 15 years on the outside, mostly criticizing the Fed for keeping rates too low for too long. He worked for Stanley Druckenmiller's family office. He's married to an Estee Lauder cosmetics heiress whose net worth is estimated around $1.9 billion. He has roughly $100 million in personal assets he'll need to divest before taking the chair. So that's the resume. Here's where it gets interesting. At his confirmation hearing on April 21st, Warsh did something unusual. He talked about wanting regime change in the conduct of policy and a new inflation framework. That's pretty radical language coming from someone who's about to run the most powerful central bank on earth. He said the Fed shouldn't be setting policy based on temporary price spikes from supply shocks like the Strait of Hormuz, a position that's directly opposite the hawkish stance he was famous for in 2008. Invesco's chief investment officer wrote afterward that Warsh's tone was increasingly dovish compared to his first stint at the Fed. JP Morgan's chief economist said his best guess is that Warsh will make the case for rate cuts in the short term, but his instincts will probably drift hawkish over time. Deutsche Bank wrote in a research note that they still don't view Warsh as structurally dovish, that historically his views skew hawkish. So we have a person who was nominated by a president who has publicly said he wants rates as low as 1%. A person whose Senate banking vote was 13-11 along straight party lines, the first fully partisan committee vote on a Fed chair in the history of that committee. A person whose hearing went so unusually that one former Fed economist, Claudia Sahm, told Fortune magazine that Warsh's jokey replies to senators were a disrespect I have never seen a Fed chair show in testimony. Her quote was, "This is not normal is going to be a theme." And then there's the Powell situation, which is genuinely strange. Jerome Powell announced at his final press conference that he is not leaving the Fed when his chairmanship ends. He's staying on the board of governors. His term as a governor doesn't expire until January 31st, 2028. That makes him the first outgoing Fed chair to remain on the board since Mariner Eccles in 1948. So Warsh is going to be sitting in meetings, voting on rates, with the man he's replacing in the same room. Powell explicitly said he was staying because of concerns about institutional independence. Here's the thing most people miss. The Fed chair has exactly one vote on the FOMC, 1 out of 12. The chair sets the agenda and shapes the conversation, but the chair cannot just decide to cut rates. 3 regional Fed presidents, Cleveland, Minneapolis, and Dallas, already dissented at the April meeting against even keeping the language that hinted rate cuts might be coming. They wanted the door left open to rate hikes instead. Those 3 are still there. Powell is still there. So even if Warsh walks in on May 15th wanting to cut rates immediately, the math doesn't necessarily work. Trump has publicly said he wants rate cuts as soon as the June 16-17 meeting. Warsh, if he wants any credibility at all, can't be seen openly delivering that. The pressure on him is immense in both directions. Move too fast and he's a sock puppet. Move too slow and he's the guy who threw a recession to prove his independence. This is the situation silver is sitting inside. So how do you trade a market when the single biggest variable is a person whose behavior nobody can predict? You don't try to. You watch the data instead. And right now, the data is starting to shift. 3 days ago, on May 6th, silver jumped more than 6% in a single session, breaking back above $77. By yesterday, it was over $80. That's the biggest move silver has made in either direction since the January crash. The reason is specific, and it has nothing to do with Warsh. According to reporting from Axios and confirmed by multiple outlets, the White House is close to a deal with Iran to end the Strait of Hormuz conflict and start formal nuclear negotiations. The proposal, and these are the broad strokes, would have Iran accept enhanced UN inspections, halt nuclear enrichment for somewhere between 12 and 15 years, possibly transfer highly enriched uranium out of the country, and limit underground facilities. In return, the U.S. would gradually lift sanctions and unfreeze billions in Iranian assets. Reports out this week describe a 1-page memorandum of understanding sent through Pakistani mediators aimed at formally ending the conflict and gradually reopening the strait. If that goes through, oil falls, inflation pressure eases, the Fed gets the room it needs to start cutting rates, and silver gets back the tailwind it lost in January. That's the entire reason silver is back near $80. The market is pricing in the possibility, not the certainty, the possibility, that the supply shock that's been crushing precious metals for months is about to lift. But here's the wrinkle. On the same day silver was rallying, Federal Reserve Bank of Chicago President Austan Goolsbee gave a speech warning that inflation has not continued cooling toward the Fed's 2% target. Inflation has actually accelerated since the war started. The number sitting in front of the Fed right now is 3.3%. So even if oil falls and the geopolitical pressure eases, the inflation problem doesn't disappear overnight. This brings us to May 12th. That's the date of the next U.S. inflation report, the CPI release for April. It lands 3 days before Warsh takes over, Whatever that number says is going to set the tone for everything that comes after. If CPI prints at 3% or below, meaningfully better than the 3.3% we've been stuck at, that gives Warsh enormous cover to signal openness to rate cuts in his first weeks, without looking like he's surrendering to political pressure. That's the bullish silver scenario. If CPI prints at 3.3% or higher, same as before or worse, Warsh has nothing to work with. He has to stay neutral. The Fed stays on hold. Silver probably stalls. I want to draw your attention to something here because it's the single most useful thing you can do as a silver holder right now. You don't have to predict any of this. You just have to know which signals to watch for and what they tell you. The dollar index is the cleanest signal. If the dollar weakens, moving below 97, say, into the mid-90s, that's the market betting on rate cuts and a softer Fed. Silver tends to move inversely to the dollar. Watch the dollar, you're watching silver's main headwind. The gold to silver ratio is the second one. It's currently around 62 to 1. When silver outperforms gold and that ratio compresses, it tells you investment demand is returning to silver specifically, not just to precious metals generally. That's historically been the cleanest sign that silver is leading a real precious metals rally, rather than just following gold. And the third one is just the language Warsh uses in his first public speech as chair, specifically the words around inflation. If he distinguishes between supply-driven inflation and demand-driven inflation, that's dovish. It's a framework that allows him to cut rates without ignoring the inflation number. If he talks about inflation as a single problem that requires sustained restrictive policy, that's hawkish, and you should expect silver to struggle. 3 signals, all visible to you in real time, all more reliable than any forecast. But none of this answers the big question. Even if Warsh goes dovish, even if oil falls, even if rates eventually come down, does silver actually have room to run from here? Or has the easy money already been made? That's where the real argument is. I want to walk you through the most extreme bullish and bearish forecasts on Wall Street right now, because they tell you something important about how wide the range of credible outcomes actually is. On the bearish side, the most concrete number comes from JP Morgan. They forecast silver averaging around $81 an ounce across 2026, with a Q4 high of $85. That's a forecast we're already trading at. Their analyst, Marko Kolanovic, warned earlier this year that silver could crash back to $50 if speculative positioning unwinds before the fundamentals catch up. UBS just cut its silver forecast last week. The new June target is $85, down from $100. They cited weaker investment demand, softer industrial usage, and rising mine supply. So the moderate to bearish institutional view is basically silver is fairly valued right here. Don't expect dramatic upside. There's downside risk if positioning unwinds. Then you have the bullish side, and the numbers get a lot bigger. Bank of America's head of metals research, Michael Widmer, has a 2026 target range of $135 to $309 per ounce. That's not a typo. The high end of his forecast is silver tripling from where we sit today in less than 8 months. His logic is built around 2 things. Gold to silver ratio compression. Historically, the ratio averages around 60, but in extreme bull moves, it can fall to 30 or below, and the supply deficit that physical buyers are now bidding through paper contracts to access. Citigroup raised its 3-month silver target to $150 in January, citing strong Chinese buying. Commerzbank has end of 2026 at $90. First Majestic CEO, Keith Neumeyer, has been calling for $100 to $200 for a couple of years now. Some independent analysts are calling for $185 within 12 to 18 months based on what they describe as a permanent shift in price discovery away from Western paper exchanges toward physical Eastern markets. That's the spread. $50 on the low end, $309 on the high end, from the same metal in the same year, from analysts looking at the same data. What does that tell you? It tells you the market has no consensus, which, paradoxically, is a useful thing to know. Markets that have a consensus tend to be priced for that consensus. Markets that don't have a consensus tend to move violently when new information arrives, because positioning is split. That's the environment we're in right now. Here's what I've concluded after going through all of these forecasts, and I want to be honest that this is my read, not anyone else's. The bear case requires a specific sequence. It requires the Iran deal to fall apart, oil to stay near $100, inflation to stay at 3.3% or higher, Warsh to lean hawkish, and speculative longs to capitulate. That's possible. It's not impossible. But every one of those conditions has to hold. The bull case requires fewer things to go right. It mainly requires the Iran de-escalation to continue, oil to fall, the Fed to start cutting at some point this year or next, and the structural deficit to keep doing what it's been doing for 6 years. The deficit isn't a forecast. It's a fact. It's been happening for 6 years, and it's going to keep happening because of how silver mining works. The most likely outcome, in my view, isn't the extreme bull case or the extreme bear case. It's something more like Silver finds a base somewhere between $70 and $85 over the next 2 to 3 months, while Warsh figures out what kind of chair he wants to be. Then, depending on what happens with rates and the dollar, silver either grinds higher into the high double digits by year end, or it consolidates sideways while the structural pressure quietly builds for another leg up in 2027. The catastrophic crash to $50, that scenario is real, but it requires a lot of bad luck stacking up at once. The moonshot to $300, that scenario is also real, but it requires conditions that historically only show up in actual financial panics. The boring middle is where most realistic money gets made. But there's one thing I haven't talked about yet that affects all of this, and it might be the single most important factor for silver over the next decade. Every silver discussion online focuses on Western financial markets, the Fed, the dollar, ETFs in New York and London. That's where the price gets set. What almost nobody talks about is that the actual physical metal is increasingly moving east, and the mechanism that's been holding silver prices down for decades may be quietly breaking. Here's what I mean. For most of the last 40 years, silver was priced through paper futures contracts on COMEX in New York and the LBMA in London. Most of those contracts were settled in cash, not physical metal. So you could sell paper silver in volumes far exceeding the actual physical supply, and the price would still hold because nobody was demanding delivery. That has been changing. In the last 2 years, more buyers have been demanding physical delivery. COMEX delivery stress has been showing up in market data. Vaults in London have been visibly drawing down. According to one analysis I came across this week, the banks have issued paper contracts promising over 337 million ounces of silver, far more than is actually available for immediate delivery. When even a fraction of those contract holders demand the physical metal, the price discovery mechanism that's been suppressing silver doesn't work anymore. You don't have to take the conspiracy version of this story to recognize what's happening. JP Morgan's own research division acknowledges that silver's price formation is changing. Analysts at major banks are openly writing that Eastern markets, Shanghai in particular, are starting to take a larger role in setting the silver price. Russia officially added silver to its state fund reserves last year. China is buying. India is buying. The structural physical demand isn't a theory anymore. It's showing up in the inventory numbers. Now, here's where it ties back to where we started. Why does silver care so much about a Federal Reserve chair appointed in Washington? Because right now, silver still trades primarily off Western financial conditions. The Fed sets the dollar's direction. The dollar sets silver's direction. That's the relationship most retail investors are working with, and for most of the last 40 years, it's been correct. But the physical demand, the structural deficit, the Eastern accumulation, those things don't care about the Fed. They're going to keep happening whether Kevin Warsh is dovish or hawkish, whether oil is at $50 or $150, whether the Strait of Hormuz is open or closed. Every year that the deficit continues, the gap between paper price and physical reality gets a little wider. What that means in practice is that the Fed transition matters enormously for silver in the near term, the next 6 to 12 months. But it matters less and less for silver over a 5-year horizon, because the structural drivers are operating on a different timeline than monetary policy. If you're a trader, May 15 is everything. If you're a long-term holder, May 15 is one date among many on a chart that's heading in a particular direction, whether you can see it day to day or not. Both of those things are true at the same time. And how you feel about silver right now probably depends on which timeline you're actually operating on. Let me bring it back to the 3 questions I started with. What does May 15 actually trigger? Not as much as people think. Warsh probably gets confirmed. He probably steps in carefully because he doesn't have the votes to do anything dramatic, and because aggressive moves in either direction would shred his credibility in his first month. The June FOMC meeting is the first one he chairs. That's the meeting to actually watch. May 15 is the start of a process, not an event. Why has silver bounced back $6 in a week? Because the Iran situation is de-escalating and the market is pricing in the easing of the supply shock that's been crushing precious metals since January. The bounce is real. Whether it sustains depends on whether the Iran deal actually closes and whether the May 12 CPI cooperates. And the big question, is the bull case right or is the bear case right? Honestly, both contain real arguments. The honest read is that the boring middle is most likely. Silver bases between $75 and $85 for a while, then moves higher when the rate environment shifts. Not $50, not $300, somewhere in between with a structural deficit doing more of the heavy lifting every year. Here's what I think the actual lesson of this whole story is, and I'll be direct about it. The people who got hurt the most in the silver market over the past few months were the ones who had a single answer they were emotionally committed to. The bulls, who were sure $200 was coming by spring. The bears, who were sure the whole thing was a bubble that would unwind to $40. Both of them ate losses. because the market doesn't owe anyone a clean narrative. The people who navigate this stuff well, and I'm not claiming to be one of them, I'm just describing what I've observed, they tend to hold positions they can hold through both directions. They watch specific signals instead of stories. They size their positions so a 40% drawdown is uncomfortable but not catastrophic. They don't try to predict the Fed chair. They watch what the dollar does after the Fed chair speaks. If you're holding silver and you're underwater from the January peak, the question isn't whether to panic sell or hold for the moonshot. The question is, does the position you're holding match your actual time horizon? If you bought silver thinking it was a 6-month trade, the past 4 months have been brutal, and that's the lesson. If you bought silver thinking it was a multi-year position based on the structural deficit, then nothing has actually changed except the entry price you'd have if you were buying today. 2 more things, and I'll let you go. First, watch the dollar index more than you watch the silver price. If you can only check one chart per day, that's the one that's going to tell you the most about where silver goes next. Second, May 12th, the CPI print. It lands before Warsh takes over. If it's below 3%, silver probably continues higher into the Fed transition. If it's at or above 3.3%, expect the bounce to stall. Where do you actually stand right now? Are you adding to your silver position at these levels, holding what you've got and waiting? Or do you think the worst is still ahead and the smart move is to step aside?